Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Davita Inc. Annual Report. Davita Inc. offers a wide range of services and businesses that cater to patients with chronic kidney failure. At the core of its operations are kidney dialysis centers, where patients receive treatment for their condition. The company also provides related lab services in outpatient settings, ensuring that patients have access to necessary tests and treatments. In addition to these primary services, Davita Inc. offers various other businesses and services. These include home-based hemodialysis services, allowing patients to receive treatment in the comfort of their own homes. The company also operates clinical laboratories that provide routine laboratory tests for dialysis and other physician-prescribed tests. Furthermore, Davita Inc. provides management and administrative services to outpatient dialysis centers, supporting these facilities with operational expertise. The company also offers integrated care and disease management services to patients in risk-based arrangements, as well as clinical research programs and physician services. In a broader sense, Davita Inc.'s comprehensive kidney care services encompass all aspects of patient treatment, from diagnosis to post-treatment care. Its transplant software business is another significant area of operation, highlighting the company's commitment to innovation and technology in the healthcare sector. Der Actionkurs von Davita Inc. DVA, hat sich in den letzten 12 Monaten deutlich verschlechtert. I am Kalenderjahr 2025 Verler der Actionkurs insgesamt 25% Senswärts, was über dem Erwarteten Rückgang von -1852% lag. Eines der Hauptgrund für diesen Rückgang sind die sinkende Anzahl und Dialysation, unterdurchschnittliche Prognosen des Unternehmens und Unsicherheit bei den Erstattungssätzen. Der Ransomware-Angriff im April 2025 führte zu einer Datenschutzverletzung von der 27 Millionen Personen betroffen waren und kostet dem Unternehmen 45 Millionen US-Dollar. Darüber hinaus trugen allgemeine Kostensteigerungen zum Druck auf den Actionkurs bei. Im Januar 2026 erreichte der Davita Actionkurs ein 52-Wochen-Tief von 10,837 US-Dollar, was einem Rückgang von 33,52% gegenüber dem Vorjahr entspricht. Trotz eines Anstiegs des Actionkurses, im Februar 2026, nach starken Ergebnissen für das vierte Quartal 2025, gab es weiterhin Bedenken hinsichtlich des Erstattungsrisikos. Aufgrund eines erwarteten Gegenwinns von 40 Millionen US-Dollar im Jahr 2026 durch das Auslaufen der Erweiter Steuergetriffen für ACA-Plan. Davita Inc. maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Davita Inc. trades at a lower price-to-earnings ratio of 15 times and a lower price-to-book ratio of -15.19 times relative within the industry. This suggests a potential market detachment, as Davita Inc. trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company exhibits a very high leverage profile, with liabilities accounting for 88% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company's dialysis services can be attributed to several key factors. Firstly, government-based programs such as Medicare and Medicare Advantage plans play a significant role, accounting for 57% of U.S. dialysis revenues. Commercial insurance plans also contribute substantially, making up 32% of the total revenue. Changes in reimbursement rates from the Centers for Medicare and Medicaid Services, CMS, can have a notable impact on revenue growth or decline. For instance, an increase in ESRD freestanding facilities' average reimbursement by 2.2% can lead to higher revenues. Conversely, when Medicare becomes the primary payer, resulting in lower average reimbursement rates, it can negatively affect revenue. In addition to these factors, other drivers of revenue growth or decline include increases in patient services, revenue per treatment, and revenue growth in ancillary businesses, such as international operations, and U.S. other ancillary businesses. Furthermore, changes in commercial payer rates and negotiation pressure can also impact revenue, particularly with regards to phosphate binder sales. Overall, the primary drivers of revenue growth or decline for a company's dialysis services are complex and multifaceted, influenced by various government programs, reimbursement rates, patient demographics, and market trends. The net income of a company has experienced fluctuations over the past 2 years. In 2024, it decreased due to various factors such as reduced commercial insurance coverage, increased labor costs, and substantial resources expended on union campaigns. However, in 2025, operating income decreased by $46 million, minus 2.2%, from 2024, while adjusted operating income increased by $113 million, 5.7%. The net income also decreased by $37 million, minus 1.7%, from 2024 to 2025. Profit margins have also seen a decline in recent years. In 2024, they declined due to lower payments from commercial payers and increased competition among private payers. However, the effective income tax rate has increased from 18.3% in 2024 to 21.8% in 2025. The company's profit margins are also implied to be affected by foreign exchange risk. The changes in net income and profit margins can be attributed to various factors, such as reduced commercial insurance coverage, increased labor costs, substantial resources expended on union campaigns, and decreased operational flexibility and efficiency. Additionally, the company's reliance on reimbursement rates for pharmaceuticals and medical equipment/supplies has also contributed to the fluctuations in net income and profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data from various sections of the report confirms this trend. On page 53, it is stated that the company generated $1,887 million in operating cash flows. This figure is consistent with the net cash provided by operating activities reported on pages 62 and 68, which also stand at $1,887 million and $2,022 million for 2025 and 2024 respectively. This consistency across different sections of the report underscores the company's ability to generate positive operating cash flow. The fact that this trend has been observed in both years suggests a stable financial performance. Overall, the data indicates that the company is successfully generating sufficient cash from its operations to meet its financial obligations and invest in growth initiatives. The company's debt level has undergone significant changes over the past few years. Initially, the debt level increased due to new loan facilities and senior note issuances, resulting in a substantial rise in debt. However, this trend was reversed when the company refinanced its term loan A-1 and made partial prepayments on its term loan B-1, leading to a decrease in debt levels. Despite these fluctuations, the total debt and leases remained relatively stable at $16,277 million from 2025 to 2026. In terms of interest expenses, there was a notable increase in 2025 due to the rise in long-term debt balance and the expiration of interest rate cap agreements. However, this trend did not continue into 2026, as interest payments on credit facilities and senior notes only increased by $70 million from $2,931 million to $3,001 million. Overall, while there have been some changes in debt levels and interest expenses, they have largely remained stable over the past year. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. Segments that performed well include ancillary services, which saw a significant surge in revenue growth at 27.3% annually, accompanied by an impressive 1,362.5% increase in adjusted operating income. This indicates a strong financial performance and potential for future growth. On the other hand, the U.S. dialysis business faced challenges such as intense competition and pricing pressures. As a result, it experienced a decline in operating income of 1.7% annually, with only a modest 1.1% increase in adjusted operating income. This underperformance suggests that the company needs to reassess its strategy for this segment to improve its financials. Management's discussion in the Davita Inc. annual report highlights a positive outlook for the company. Despite facing increased competition and changes in government policies, revenue growth and operating income have been achieved. The company is also adapting to innovative technologies and trends, such as value-based care and integrated kidney care. The financial highlights demonstrate the company's ability to navigate these challenges and achieve success. Management is focused on leveraging these trends to drive future growth and expansion. Overall, the report suggests a confident and forward-thinking approach from management, with a focus on positioning the company for long-term success. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has been expanding its presence in the international market by acquiring or developing dialysis centers. This includes the development of new outpatient dialysis centers and mergers with other companies. The company has also invested in joint ventures and non-controlling interest investments. One notable acquisition is the purchase of 76 international dialysis centers, valued at $4,750 million. Additionally, the company has established a term loan A-2 facility with an aggregate principal amount of $2,000 million and a term loan B-2 facility with an aggregate principal amount of $1,878 million. In terms of divestitures, the company has sold its Davita Medical Group, DMG, to a subsidiary of Optum Inc. on June 19, 2019. The company has also closed or sold several dialysis centers, either by selling them to other companies or closing them down altogether. This includes 3 dialysis centers that were closed but had their patients transferred to existing outpatient facilities. Overall, the company's acquisitions and divestitures reflect its efforts to expand its presence in the international market while streamlining its operations and reducing costs. The company has made significant investments in its shareholders through a strategic buyback program. In 2025, the company repurchased a substantial number of shares, totaling 12,679,000 at an average price of $140.09 per share. This was followed by additional purchases subsequent to December 31, 2025, with 1,772,872 shares acquired at an average price of $122.08 per share. These buybacks demonstrate the company's commitment to returning value to its shareholders and enhancing their equity stake in the business. Concerns about inventory buildup and supply chain disruption are evident in various areas of the industry. Severe weather events, economic conditions, and general disruptions can lead to shortages and delays in equipment and clinical supplies. Suppliers may also experience prolonged supply chain disruptions due to macroeconomic conditions, global events, or natural disasters. Material price increases from suppliers are a possible consequence of these disruptions. Additionally, evolving trade policies and tariffs can cause supply chain challenges and disruptions. The industry is also vulnerable to disruptions experienced by third-party vendors and reductions in clinical supplies due to supply chain issues. These concerns indicate potential risks related to inventory buildup and supply chain disruption. That concludes the financial summary for Davita Inc. Feel free to comment below, and I will be happy to answer them when possible.